April marks the beginning of the second quarter, and we are walking into this quarter, with positive risk appetite. And there's a lot to look forward to over the next few months. However, with US stocks, gold, and Bitcoin trading at record highs, while dollar-yen hovers near a 3-decade high, there are certainly more questions than there are answers. Hello everyone, this is Kathy Lee with BK Traders, and our channel is focused on helping you become a better trader through explaining fundamentals and sharing some of our favorite technical trading tips. In this video, we're going to talk about what to watch in the month of April. What's behind the big moves in stocks and gold? Will stocks and gold and Bitcoin continue to power higher? What are the risks to the rally? What could bring these moves to a screeching halt? And what seasonal patterns do you need to know? Because there are some very interesting ones in the month of April. First and foremost, it is important to understand that the rally in stocks have been fueled by the combination of stronger, better US data and falling inflation. Prices should continue to fall, which is positive for the stock market. And so far, data like this week's ISM manufacturing report continues to surprise to the upside, highlighting the underlying resilience and strength of the US economy. Gold, which is usually seen as a hedge against market losses, is also performing well. But this has less to do with the outlook of the US economy than what's really going on in other parts of the world, non-US countries. In countries like Germany, UK, Canada, China, and New Zealand, growth has been weakening. Soft stock markets outside of the US have been underperforming, with Hong Kong's Hang Seng Index, for example, down 18% over the last year, as US stocks are at record highs. And this really shows that divergence between what's happening in the US and another part of the world. A lot of the demand for gold is actually coming from Asia, particularly China, where investors are looking to hedge against political, economic instability and a burgeoning property crisis. They're basically looking to put their money elsewhere. American investors are also thinking in the same way, diversifying against geopolitical instability that's being caused by the wars between Israel and Hamas, and Russia and the Ukraine, along with the risks around November's presidential election. But April and December are tied as the best performing months of the year for stocks, according to Reuters, and according to the numbers in general. And while past performance is never indicative of how stocks will behave going forward, looking at seasonality can provide some important insight into how assets like stocks could perform in certain times of the year. It can be very valuable for traders. Now, one theory is that investors receive their tax funds in April, and what they typically do is invest that money back into the market, which ends up pushing prices higher. While this may or may not be the real reason, but I think there's certainly some justification there, stocks have only posted a loss twice in the past 18 years. Let that sink in. Only 2 times in the past 18 years. That's a trend that's hard to fade. As you can see in this chart, April is also the 3rd strongest month for gold, behind December and January. So from a seasonality perspective, and take it for what it's worth, stocks and gold could actually see new highs, more gains this April. Now, for my currency traders out there, April is also the strongest month historically for the British pound, according to tables compiled by StoneX. As you can see in this chart, since 1971, we have seen performance in April completely eclipse that of any other periods or months in the year. On the flip side, interestingly enough, April is actually the worst performing month for the Canadian dollar. And it is a pretty weak month for the Japanese yen. So that could provide a nice, pound CAD, pound yen opportunity maybe. You may be wondering, what about the euro, the most actively traded currency? Well, there doesn't really seem to be any meaningful seasonal pattern to report. All I can say is that since 1971, it's been mildly positive. But when it comes down to it, it's really economic data that will determine whether the trend in stocks, gold, and the US dollar will continue in the month of April, because that will also determine whether the Federal Reserve and other major central banks lower interest rates in June, or sooner or later. While the risk of recession in the U.S. has diminished significantly, cracks are beginning to show. And that's what investors will be looking for in the month of April. They'll be looking for more evidence of, weakness in the U.S. economy becoming more material. We do have more companies that are announcing layoffs, and job openings are actually down 25% from their peak in 2022. So the U.S. labor market could be cooling, and it is. Credit card and auto loan defaults are rising, along with commercial real estate delinquencies. So the property market, the credit in the U.S. is softening. European growth is also weakening. March was a big month in the global markets. The Bank of Japan raised interest rates for the first time in 17 years, while the Swiss National Bank became the first major central bank to lower interest rates. We're not expecting any of these historically significant moves to be made in the month of April. However, the European Central Bank did lower their growth and inflation forecast when they last met, leading investors to predict that the ECB could cut before the Federal Reserve eases. And this will be something that I will be watching very closely, because it will have an impact, a significant impact on the euro, the dollar, and the euro-dollar pair, which many of you trade. The Bank of England said things are moving in the right direction for easing, while the Reserve Bank of Australia dropped their tightening bias. So changes and tweaks are being made to set us up for some big moves in the summer, not in April. The Federal Reserve is still calling right now for 3 rate cuts this year. But if U.S. data continues to surprise the upside, like the ISM manufacturing report we came out for the first day of the month, the odds for 2 rate cuts this year could grow. And that will have a direct impact, and probably a significant impact, on stocks, gold, and the U.S. dollar. If expectations get paired to 2 rate cuts from 3, that's going to be bearish for stocks and bullish for the US dollar. There's a lot to watch this month. Don't miss any updates. Make sure you subscribe to our channel and click the notifications bell, because I will be updating you on all of these trends as they progress. I will see you all next time. Good luck in the markets.